suicide or rather crucified.
Yes, your boy Crypto Blood, and welcome to another episode of My 2 Cents. This morning we're looking at something out of China. Looks like they may be the next country to go ZIRP, or that's zero interest rates. Like we need another country to do that. So we're going to take a look at that out of Zero Hedge, and also something that you guys should be aware of. This is out of Reuters. Looks like some U.S. banks are going to be forced to stop their short-term lending in the repo markets by the end of the year to avoid triggering requirements that will force them to hold more capital if they do continue to borrow in the short term. So I thought this was critical and maybe something that will actually kind of expose some of these banks. And what will happen then? Will the Fed just move the goalposts? I think so. They'll just change the terms and conditions for these banks. That's all they will do. But we're going to take a look at this out of Reuters. But you know the routine. Make sure you click the thumbs up. Losers, click the thumbs down and subscribe to this channel. And don't forget to click that notification bell to receive more videos like this. Dow Jones ended the week up another 109 points, 0.39%. Almost getting back to that all-time high. We'll see if that can happen this week. Opening up today. Gold to the contrary down 0.34% as it continues to slide against the dollar. But before we get into the main topic today, I do want to bring to your attention the fear gauge, or VIX. Guess what it's doing? It's moving lockstep with the stock market. So normally there's an inverse correlation with this. So we have what's called a divergence away from the normal correlation, which normally means something in the markets. A big turning point is coming. So it says the PBOC volatility index, which typically trades inversely with stock prices, has been moving in tandem at times with the S&P 500 for the first time in 6 months. Negative news on China trade has done little to lift market volatility recently. It says an unusual trend in the stock market emerged recently as the latest sign that perhaps greed is the driving force behind the rally and investors are ignoring some key risk. Wall Street's Fear Index, or VIX, which typically trades inversely with the stock price, started moving in tandem at times with the S&P 500 earlier this month. The rolling 10-day correlation between the VIX and the S&P 500 turned positive on November 14th. The first time this has happened in 6 months. The so-called VIX is a measurement of the stock market's 30-day expected volatility computed from the market's price of the call and put options on the S&P 500. When the market goes down, though, investors would want to purchase insurance, which drives up the price of the put options and increase the VIX. The VIX decreases when there's less demand for puts and the market rises. The fear gauge is also flirting with a 2-year low, hovering around just 13 points. So just wanted to give you guys an update on that to let you know that we're starting to see some behaviors in the market that are unusual. And those are the little telltale signs you need to pay attention to. So just mark that in your calendar. November 14th is when we started seeing a positive correlation with the VIX and the S&P 500. And this is an interesting article also out of Zero Hedge talking about the 150 years of credit expansion that we've seen just globally. It says today we face infinite monetary inflation as a final solution to 150 years of monetary failures. The coming systemic and monetary collapse will probably mark the end of cycles of the bank credit expansion as we know it, and the final collapse of fiat currencies. So fast forward to the current position. Since the turn of the millennium, there have been 2 global bank credit crises. The first was the deflation of the dot-com bubble in 2001 and 2, and the second 2008 and 9 financial crisis that wiped out Lehman. And I want to just interject. I know we're talking about post-millennial crisis as far as credit, but we can't forget long-term capital management. We can't forget that happened in the 90s, and I think that really kicked everything off. That was the start of this whole credit issue that we have, and it's recurring, and it's happening closer and closer together if you pay attention to the pattern. The article goes on to say it was clear from these events that the debate over moral hazard was resolved in favor of supporting not just the banks, but big business and stock market valuations as well. And the forthcoming credit crisis could repeat 1929 and 32 era, an extreme amount of monetary creation over the last 10 years, and the U.S.-China trade war over the last 2 is horribly reminiscent of late 1929, when the combination of the end of the credit cycle and escalating trade protectionism combined to wreak financial destruction on a global scale. Even a halt to the trade war between the U.S. and China is agreed in the coming weeks. A crisis has been triggered, and our empirical evidence suggests it gets worse from here. it appears that common sense on trade policy is unlikely to prevail because the conflict is far deeper than just a trade. So we'll have to see if this actually happens. I think it will. A fraud, certainly. And we're just seeing these elements of this fraud continually appearing, rearing its ugly head every week now. It's getting worse every week. It used to be maybe every couple of years, every couple of quarters. And now it's every week we're hearing something new. They're trying something new. And now this out of Reuters, referring to what U.S. banks may have to start doing here. It says that data posted on Friday by the Federal Reserve showed 4 of the 6 biggest U.S. lenders were above or close to thresholds that would increase their capital surcharges. An easy way to get the scores down would be doing less lending through overnight repurchase agreements and foreign exchange swaps, said an analyst who tracks the filings. Those markets have experienced stress in recent months. Retreats by lenders would make them more vulnerable. Josh Younger said, a derivative strategist at JP Morgan, if the economy narrative shifts in December, it could have a greater impact than if it were to shift at any other point in the year. Calculations from September data in the JP Morgan Chase filing, for example, indicate that its score as a global systematic important bank, or GSIB, was 751, or 21 points above the level at which its capital surcharge would be increased to 4% rather than 3.5. If JP Morgan doesn't get below 730, it will have to hold another $8 billion of capital, analysts estimated. That would dampen return on equity. The bank has said it will be under the threshold. The Fed began imposing GSIB surcharges in 2016. Goldman Sachs needs to take at least 16 points from its score to avoid a higher surcharge, and Bank of America Corp needs to shave 8 points. Citigroup is 2 points under a markup, but could seek a wider margin because higher fourth quarter stock prices are posed to add to all scores. Backing away from certain short-term lending instruments, particularly swaps and other derivatives, is one of the easiest temporary ways to reduce scores, which are compiled from dozens of measurements and calculations. So what this tells me, this is interesting here, what this tells me, it kind of gives us a glimpse into which banks are kind of more in trouble than others, right? It's showing us that JP Morgan has 21 points to shave versus some of the other banks, i.e. Goldman Sachs, only 16. Bank of America only needs to shave 8, and Citigroup only 2 points. So that will kind of give us, at least the top banks, the big banks, gives us a kind of a glimpse into their health from a overnight short-term repo lending perspective. Now, this doesn't mean that they're in trouble. There could be other banks much smaller, maybe regional banks that are in trouble here, but just kind of gives us a glimpse into what some of the big banks' health status is when it comes to that. So I thought this was interesting, and I'll make sure I leave a link to this so you guys can check this out. But the main article that I really want to take a look at, which is crazy, now China looks like will be the next country to cut rates to zero. Can't say I'm surprised, and neither should you. It said 1 week ago, Zero had showed in one chart why the global economy recovery that so many expect is just a few months away won't happen. As the chart below shows, China's credit intensity since 1994 has exploded. This means that before the global financial crisis, China needed on average 1 unit of credit to create 1 unit of GDP. But since 2008, 2.5 units of credit are required to create 1 unit of GDP. In other words, China needs much more credit than 10 years ago to have the exact amount of impact on GDP. Injecting more credit into the economy is not the miracle solution it used to be, and the disadvantage of credit push tends to surpass the advantages. This explosion in China's credit intensity in the past decade has directly fueled China's debt engine, the same debt engine that single-handedly pulled the world out of the global depression in 2008 and 9. Alas, this will not happen again. China's public and household debts are at their highest historical levels. So as you can see that from this chart, here's the total debt to GDP, and it is just rising. Insane. And some economists and analysts already believe that China's interest rates are at or negative currently, but not officially, right? But of course, by the time China does approach ZIRP, the trade war between the U.S. and China will be at such a heated and if not outright kinetic level that few will notice or care what Beijing's monetary policy is. The Federal Reserve continuous interest rates cuts have triggered a race of interest rate cuts among central banks around the world, increasing excessive global liquidity even further. So in this case, more countries are faced with monetary conditions of zero or negative interest rates. Recently, former U.S. Fed Chairman Alan Greenspan noted that negative rates are spreading around the world. Some financial institutions even believe the world will enter a low rates condition that hasn't occurred in over 1,000 years. So under this condition of low interest rates or even zero interest rates, the world's debt level keeps rising and the bond yields continue dropping. Another phenomenon comes with low interest rate monetary conditions is that prices go up with risk assets, i.e. U.S. stocks. And this is what I think we'll continue to see a melt up in the U.S. stock market. Okay. And it won't really, in my opinion, manifest in precious metals. I'm still up in the air about cryptocurrencies, though I think if any money were to spill over, it would have a greater impact on cryptocurrencies than it would gold. That's what I'm banking on. For China, the demands for liquidity are growing, foreign capital keeps flowing in, and the real economy continues to slow down, which all makes the country seemingly approaching a zero rates monetary condition. So China's overall debts accounted for 306% of their GDP, up 2 percentage points from 304% in the first quarter, according to a report from the Institute of International Finance. So we'll have to see what happens here, guys. I mean, to me, they're pretty much forced. Their hand is forced, and really it's forced because of us, because of the United States, the Federal Reserve, and whatever the Federal Reserve does, it's like a shock wave across the globe, and all of these central banks have to react and accommodate for what actions are taking place here, because we are still at this current point. I think the de-dollarization is coming, but at this current point, we are still the reserve currency. So what we do with our monetary policy affects everyone else. So you guys let me know, what are your thoughts about this? And more importantly, I think the shocker in today's video comes out of Reuters, and seeing that some of these banks are going to have to slow down on these repo short-term lending activities. So let me know your thoughts about this. How is this going to affect things come December? So December is going to be a big month. It's going to be possibly fireworks, I think. We'll have to see how everything happens and plays out and how the Federal Reserve reacts. Man, interesting times we're in. But make sure you guys like, share, and subscribe. And surely click that bell. Sure, we're Crypto Blood, and that's my 2 cents for today. I'm out of here. Holla.
Seen a Cuban kilo, I was 15.